yeah, I had to move to a different venue quickly to get access to electricity and internet. So welcome to everybody that is online at the moment.
Hallo daar. Hi Gerald.
Chris, gaan het goed?
Eerste klas, maar baie dankie hetzelfde.
Lekker man, lekker. Michael, as soon as you go online, you can just raise your hand, then I can just see where you are. So for everybody that's on the call tonight, thank you for joining us. Thank you for spending some time with us. And we've been doing quite a bit of work in the background, doing some things for the women event. My wife that's doing that, very, very excited about it. So everybody that is involved with that, well done. Also with the activities that they are planning for the 31st. Well done on that one. Lorette, jy het jouself geunmute. Wil jy iets sê daarso? Loretta?
Ja.
Gaan dit goed daai kant?
Ja, goed, dankie. Kan jy my hoor?
Ek kan jou altyd hoor.
Oh, cool.
Excellent. So yeah, thank you very much guys for joining. I see there's about 45 that have joined. Anybody that has got some story to tell after a very, very exciting week and weekend? Can I share a story while we're waiting for the members to join? No never means no forever. We had somebody that walked into our office in the week, and they actually said that somebody talked to them in December about MTI, and then they saw the front view of the office in the Strand, and now they're ready to join. So yeah, follow up equals fortune, as we said in our previous trainings. So who knows where that guy is going to sign up? He says he can't even recall who told him about it the first time. So it's actually quite scary if people don't keep family members and friends updated with how they're doing in MTI. But yeah, the office in the Strand, or let's call it the Team Epic office that we're running there, is doing exceptionally well. There was about 5 members that walked in today. They just wanted to come and see the office, and they sat down and we gave them some training. So there I want to say thank you to Elton and also Gert, that's taking that responsibility upon them, to also teach and guide people. And yes, they are learning as they are going also. So very excited about that. Michael, if you are online yet, just raise your hand. You go to participants and then you just raise your hand there. I just want to see, oh, you're on Hawaii P20 Lite, I presume. Michael, you can unmute yourself. There we go. Can you hear me?
Hello, Bert.
Yes, who's that?
This is famous.
Okay, I thought you were Michael doing the presentation tonight.
No. No, this is famous. I was just saying hello.
Okay, awesome. Thank you. Have a good evening tonight.
Thank you.
Michael? Hello. Who's speaking?
It's Ian. Hello, Gerald.
Ian, there you are. Why are you so soft?
Is it very soft?
Clearly now.
Can you hear me now?
I can hear you clearly now.
The rain is gone. It's going to be a bright, bright, sunshiny day.
Okay. Michael, are you online?
Ja, ek is online.
Is jy online? So doen jy vanaand die presentation?
Ek wens ek was gereed, maar ek dink ek mag hier dalk net julle tyd mors.
So yeah, guys, thank you very much for joining us tonight. We are extremely excited. And yes, we will be recording this conversation. Mr. Dryden has just asked me to record it as well, so will definitely be recorded. Good evening everybody. We're still waiting about 30 seconds. And thank you very much for everybody joining tonight. We do have some special guests also online tonight. That's normally not on our call. So let's give them also a chance to join in. Goeienaand, gaan het goed? Is dit meneer Oosthuizen?
Gideon is op.
Hoe, daar is Gideon. Hallo Gideon.
Nee.
Lekker man, lekker. Jy moet mooi notas vat vanaand, hoor.
Nee, ek sal vol net ekkies maakies. Seker.
Lekker. Nee, het gaan goed in die Kaap is. Hulle sê die Kaap is Hollands, meneer. Dit keer of het gaan beter.
Klink vir jou besig is daar.
Ja, nee, ons het kyk die kantoortjie wat ons oopgemaak het nou na die lockdown, hou ons nogal redelik besig.
Ja, okay.
Maar ja, dan moet jy nog intussen jou eie mense ook help. Jy moet mense help wat inkom net in die kantoor en hulle wil net 'n paar vrae vra of hulle wil maar net weet hoe werk 'n Weller account of wat ook al. So ja, dit is baie interessant en dan vat ons nog challenges aan. My vrou het nou die women's event wat sy doen die 31ste. En dan Asher, hulle gaan vir ons 'n event reël in November, 'n blockchain event. So ja, daar's groot surprises wat kom. En intussen bou ons nog 'n besigheid.
Hi, Gerald.
Good evening. Are you good?
Yeah, good in yourself.
Very well. I see you're still sweating there, so do we need to organize you some coffee or something?
No, I just had a workout now.
Okay. So yeah, we're just waiting for a few people. Somebody just said to me that they're still struggling to get online. So just give them a few seconds there. Okay, perfect. They are on. So good evening, everybody. For the people that don't know me, because we do have some special guests here online. I'm Gerald Lassen here from Cape Town. I'm just an entrepreneur, and I'm just going to share with you guys some things tonight that I think is relevant to our business. And we do have a few special guests also tonight. But yeah, for me personally, I say there's a few things that we need to remember. Everything that we do in this group or in this call is for Team Epic. As you guys know, we stand for excellence, we stand for passion, we stand for integrity, and we stand for caring, which is also part of the core values of MTI itself. So this video and document was prepared by myself and released by myself, Gerald Lassen, and also Mr. Michael Dryden, who is our special guest here tonight. The opinions and views content expressed in these materials are not my own and not necessarily the reflection of MTI. So we basically just collect information, we share it with people, we make it available. And I think it is very relevant in our business, also to protect ourselves and also to look at taxes. So just remember that on this official statement released by Mirror Trading, I hereby indemnify Mirror Trading Pty Limited. So as I say, this is not their material. So also just remember, anybody that had inquiries or information that was shared in the last few weeks, we do have now Charlie Ward that mentioned to us if we've got any problems, any relevant things that we feel our personal information was shared on the internet, we can get that information through to the corporate team, to the legal team, and then legal team will also handle that, investigate it, and so on. So guys, remember, we are here to protect MTI, we are here to protect the membership, and we are here to grow a legacy, a future for us and also for MTI. So without further ado, I'm going to introduce Mr. Michael Dryden. Just something that maybe can stand out. I met Mr. Michael Dryden in the Twin Towers, not in London or New York or wherever the Twin Towers is. It was in Century City. And yes, we got to know each other on a corporate level, not on a personal level, but it developed into a friendship at a stage where I phoned Mr. Michael Dryden or his office, and I said to them, listen, yeah, I've got a bit of a problem. And Michael opened up the phone directly to me and he said, Joel, listen, yeah, we became good friends over a long time. So you phone me directly, don't go through the office. So I appreciate that, Michael, for also opening up your lines to us. I know you are, I can call it semi-retired, if I can call it that. But yeah, your company is at a stage where it's growing rapidly. You've got a good client base. And I think the information that you can share with us can also benefit us and the team in the future. So yeah, I'm going to hand over to you, Michael. Take the floor and take it away.
Thank you, Gerald. Just to confirm that you can hear me clearly.
I can hear you clearly, and I will give you permission to share your screen right now.
Awesome. Thank you so much.
Okay, you can share.
All right, just 1 second. Can you see my video here?
We're still waiting.
Oh gosh.
Just don't tell me you've got an Apple.
No, I don't.
Hey, Gerald, I heard that. Leave that alone.
All right. Okay, can you see it now?
There we go. There we go. Excellent.
All right. Okay. Thank you so much, Gerald. Look, I'd like to just thank you on behalf of myself, my wife, and obviously the FinServ group of companies for allowing us the privilege to participate today in this session. I'm a director of a company called the FinServ Group, FinServ Accounting. We're a group of companies that offer services in the accounting and the tax field specifically, and then in real estate as well. And this evening, I'm going to share a little bit of details around a very, very specialist entity called a trust, which most people have kind of heard of, probably through circles and things like that. But thorough information around trust is very rare. Professionals that understand it in depth and how it can benefit a person is also slim. So one of our claim to fames in our company is having given access to thousands of people in terms of the use of trust and the benefits of it. Just as a quick disclaimer for myself, I'm accustomed to doing presentations in person in groups of 100, 200 people. So not having actual feedback coming back to me in terms of the crowd's responses to things is a little bit weird for me still, doing the Zoom thing. So it feels a little bit like I'm doing monologuing to myself here, but I'm sure I'll get by. So let's climb right into it here. Let me just start this presentation here. Quick disclaimer, professional disclaimer at the bottom here. Can you see my cursor, Gerald?
Yes, we can see it.
Okay, cool. So when I'm over here, you can see it over there. All right.
Yes.
So just a quick professional disclaimer, please. This presentation is high-level things, not in-depth. It's very generic as well. So please don't take this presentation as some form of advice. Use it for high-level thinking, and once you're ready to embark on a trust journey, please make sure you consult with a professional. Ideally, we'd like you to consult with us, but of course there are professionals out there that understand this field too. But what's most important is that you do consult with a professional before you act on any of this information. So let's climb into it. Building wealth in SA. So just like any other country, human beings and the social systems that we live in, we generally have an inclination to build or accumulate wealth, right? And that's in the form of various things: property, vehicles, conventional investments, furniture, and of course this wonderful thing called cryptocurrency, new age things. But at the end of the day, we have this general inclination to build wealth and to accumulate wealth. But because of lack of education in the field of structuring, we default into registering every one of those pieces of wealth in your personal capacity. And if you think about it, when you purchase your first vehicle or your first property, they give you a document, a deed of sale or purchase agreement, whatever. And one of the first things that's on that document is who is buying this vehicle, who is buying this property. And you would just fill in by default, Michael Dryden and my ID number, and I'm the person buying it. Why? Because I want to enjoy the benefits of it. I want to enjoy the control over it. So automatically I just fill in my details. The problem is over time you build up these different forms of wealth, and at the end of the day, each piece of that wealth, be it furniture, vehicles, cryptocurrency, because it's owned by you personally under normal circumstances, it has exposure to the effects of death in South Africa and the effects of litigation. So these are the two things I'm going to expand on a little bit. I'm not going to go into too much depth. I'm going to try to keep it very light, but I'm going to finish off with a little bit of tax stuff as well, which is going to be super, super important. So please don't leave before the tax part, because that's the super exciting part. So just a quick baseline of what a trust is. When you create a trust, it's really a contract between different people. The three main people that it essentially is between, or this contract is between the founder, who is the person that actually creates the trust. A founder can have various powers in our trust deeds for purposes of tax efficiencies and risk mitigation. The founder of our type of trust has no power. The only purpose of a founder in our case is to actually create the trust, because somebody actually has to instigate it or create it. The founder then appoints a class of people called the trustees, and these are the people that are very similar to directors. They are the people that are legally allowed to control the trust. Why? Because a trust is really, just like a company, is really just a figment of our imaginations. I mean, these things don't actually exist. It only exists in the realm of papers. So a physical human being has to actually control it, and these are called the trustees. So the trustees make the decisions on behalf of this thing called a trust, similar to a director. Under normal circumstances, it's the client, you, plus one, usually the spouse, that's then as a trustee. But if those trustees are too closely aligned or too closely related, the Master of the High Court, where trusts are registered, requires you to appoint an independent trustee, somebody that is outside of that family unit. Yeah, but usually it's you plus one. The next class of people are called the beneficiaries. These are very similar to shareholders of a company, and by its very name, these are the people that are allowed to benefit from the trust. So again, under normal circumstances, that would be the client, you, the spouse, and the kids, and really anyone else you want. But the usual structure is the immediate family unit. We'll get back onto that a bit later. I just wanted to give you a breakdown. Again, founder creates the trust, trustees control the trust, and the beneficiaries benefit from the trust. The cost of dying. So there's a saying that in South Africa, dying in South Africa is very, very expensive. If you think you've paid an enormous amount of taxes during your lifetime, If you're not structured correctly, you will end up paying an enormous amount of taxes upon death too, which is really frustrating because your wealth is built up with after-tax monies, and then you pass away and that wealth is taxed again. Not cool at all. So when you pass away, all the wealth that is linked to your personal capacity, everything linked to your ID number, is subject to a process of law. It's the process of winding up one's estate. Many of us have been, again, exposed to this. Loved ones pass away, whatever. But the bottom line is, when you pass away, there is things that need to happen in terms of the procedure of law and winding up the estate. Big problem with it is that a large part of that process is making sure that certain taxes are paid. So one of the first taxes that are paid is called estate duties. People often refer to this as death taxes. This is taxed 20% of your net estate. So if you have a 10 million rand estate, they give you a little bit of an abatement, 3.5 million, and the balance then is subject to essentially 20%, which can be a substantial amount of money. Capital gains tax is the one that many people don't know of, unfortunately. So in law, in tax law, what happens is when you pass away, your death is seen as a disposal of your wealth. So for example, perfect example is Bitcoin. You bought Bitcoin at a certain amount, 10,000 US dollar per Bitcoin, 10,000 USD per Bitcoin. You keep it for 10 years and you pass away, and at that point it's worth 20,000 USD. That difference of 10,000 is what we see, what is called a capital gain, and it is triggered upon your death. So it's as if you have physically sold that Bitcoin when you pass away. Same with property. You buy a property for R1 million. You die, it's worth 2 million rand. The difference of R1 million with the growth of R1 million is subject to CGT at 18% as well. It's a horrible tax because it also doesn't take liabilities into consideration. So even if your home is bonded to the yield, it's irrelevant for capital gains tax purposes. CGT is based purely on the growth of their capital asset, and your death is seen as a disposal, as if you've sold it, and it triggers capital gains tax. So you can think about it, if there's a R1 million gain, you're talking about 180,000 Rand taxable for that. Executors fees. This is a funny one. The maximum amount that executors are allowed to charge is around 3.5%, but most of them are registered for VAT because it's a service rendered, so it's 3.5% plus VAT, so it equates to around 4%. It's an unforgiving one here as well, because the 4% is levied on your gross estate, not your net estate. So if you're, even if you have assets worth 10 million Rand and you have liabilities of 10 million Rand, your net estate is zero, but the 4% is levied on your gross estate, so it's levied on the 10 million Rand. Point is, all these different fees can wipe up to 30–40% of your estate, and the horrible part of that is that it's payable in cash. So many estates are asset strong, but liquidity weak. In other words, there's not a lot of cash flow, because obviously cash in the bank doesn't work for you, so most people invest it or whatever. So if you have a 3 million Rand tax bill, the 3 million Rand is payable in cash, and very few estates didn't have that kind of cash flow available. So what happens there is that the executor of the estate is allowed to start selling assets in order to pay for those taxes. And this is where people like us who have not died, we take advantage of things like this. We go to auctions, deceased estate auction, and we go buy up a property that is worth R1 million for 600,000 Rand. And the reason for that is that when the executor sells it, he has to sell it fast, because people need to get paid, SARS need to get paid, banks need to get paid, etc. So they don't put it on the market until it reaches its or sells for its market value. They put it on the market at a lower price, get it sold as quick as possible, and then you lose even more of your estate. And this is all happening, bear in mind that you are 6 foot under, which means you can't challenge any of these things. Your family has to deal with it. Settling of debt, you can't die with debt. So any bonds, credit cards, loans, etc. has to be settled on death. And that just creates more of a liquidity problem, because you require even more cash flow to settle these things. So if you have a house with a bond on it, house can't be transferred to the beneficiaries of your estate with the bond attached. So the bond and the loan attached to it needs to be settled. Liquidity becomes a problem. Minor beneficiaries cannot inherit. So this is super important. We have too many people walking around out there with last will and testament that says, if we pass away, my wealth goes to my child, and that child is 10 years old. A 10-year-old child can't inherit an estate. So what happens is anything that's supposed to go to that child, unless it goes to a guardian, but anything that's supposed to go to that child essentially must get liquidated, turned into cash, which again gets sold on auction at 60% of the value. And that cash then is transferred to a thing called a guardian's fund at the master's office. And it is then administered by government for the benefit of your children. So need I really say more on that, is that the guardians of your kids will have to apply for maintenance and things from that fund, from that money. And eventually when the kids are old enough, they can go and claim the money back from the guardian's fund, which is not an easy procedure in itself. And then, of course, the biggest problem, in my opinion, is the winding up process equates to a frozen estate. So as soon as you pass away and your ID number is registered as deceased, then everything linked to that ID number is frozen. So any bank accounts, credit cards, investments, properties, vehicles, everything is not allowed to be touched anymore. Things that can be physically frozen, like a bank account, is frozen, you can't access it, or your loved ones can't access it. And things like vehicles and properties and so on are not meant to be used beyond its immediate purpose, so you can't add to it, remove it, and so on and so forth. That's all well and good, but the problem is it's frozen for so long as the winding up process is unfolding. So on an average estate, small estate, you're talking a year. On a medium estate, 2 to 3 years that it's winding up, which means it's 2 to 3 years of being frozen. And for a large estate, we're talking 5 years. I mean, and as long as that estate is frozen, it means all those people that you have left behind have no access to that wealth. It is frozen in time until everybody, and this is this long list, it actually goes longer than this. This long list here is first settled, and eventually what remains is what goes to your beneficiary. So it's a very, very big misconception. People think that if you have a will, your estate is just dealt with according to your will. And, you know, if my will says my home needs to go to my 10-year-old child, it just goes to my 10-year-old child. And it's not so. The function of law has to take place first and then the will afterwards. Then we come to trusts. So what we do is we put all your wealth in trusts. And I'll expand on it a little bit later, but what happens is everything that is owned by a trust no longer forms part of your personal wealth. So this line over here, this big red line, is the legal barrier essentially between your personal wealth, which is this side here, and anything owned by trust, which is this side here. Now, the moment you move these two things across from this side to that side, it means that it no longer forms part of your personal wealth. It now forms part of the wealth of a trust or trusts. And the result of that is that when you pass away, it has no effect on these assets over here. No effect, because the trust itself does not die. The trust continues in perpetuity. And because the trust does not die, everything that's owned inside it is not subject to things like estate duties. There's no capital gains tax because there's no disposal of those properties or that wealth inside the trust because the trust does not die. There's no executives fees again because there's nothing to wind up because the trust just continues. No settling of debt, no minor beneficiary issues because it doesn't get left to the minor beneficiaries. It is held by the trust for the benefit of the minor beneficiaries. So at the end of the day, if you have all your wealth inside the trust on this side of the line, then all these things on this side disappear, which means you don't lose 30 to 40% of your estate to taxes and fees. There's no frozen period where your loved ones desperately need access to that cash and they have no access to it. It's just a wonderful situation where it becomes a seamless transition of your hard-earned wealth from your life to your loved ones, to the next generation. It's a wonderful thing. It's a seamless transition. The domino effect of risk. So the unfortunate thing about death is that it's inevitable. We are going to die one day, and therefore you'll be subject to those problems if you own wealth in your personal capacity. But the other part of it is the possibility of being sued or getting divorced and things like that. And this refers to the effect of risk or the domino effect of risk. So what happens is the typical family, as you can see here, owns a certain amount of wealth. You've got the house, you've got the furniture, you've got some cash and investments. I put a little bit of Bitcoin in there, and then a very politically neutral vehicle over there, a GTI. I get flack about that, but we'll just leave it as such. And under normal circumstances, these are the things that people own, right? And everything's going well, and you've got a great job, and then COVID hits. And in a heartbeat, you lose your job. And even though you've been paying this property over here religiously for the last 15 years, if you are unable to pay the property for 3 to 6 months, usually under COVID, they were a little bit more relaxed, but under normal circumstances, if you don't pay the property for 3 months in a row, doesn't matter if you've been paying it for 15 years straight without a missed payment, you missed 3 payments, and they will come down on you and try to repossess the house, sell the house on auction in order to make good the bank who is now apparently left out of pocket and serious damage has been done to them. So you end up, not by a fault of your own, losing your property as a consequence of something out of your control, like retrenchment or something, and you lose the property. Now, under normal circumstances, what happens is when they're done taking a property away from you, there's still lots of fees to be paid. They rack up hundreds of thousands of rands of legal fees. The property got sold in auction, so it only got 60% of its price. There's still a portion of the bond that needs to be settled. The courts then give the authority to that aggrieved creditor, being the bank in this case, to go and attach anything else that you own in your personal capacity. Anything else. If you own something, it is attachable. And remember, these things are all linked to your ID number. So what happens is you have this domino effect, and they take away the furniture, they take away your investments, all to make good this debt or fees that was unpaid after this removal of the home. And they take away your GTI over there as well. So you end up having this domino effect. It started with one and it knocks on, or domino effect, onto all the others. And there's a saying in the financial world, they say when the house goes, the spouse goes. So the family starts falling apart. And that is because when a household is in financial distress, it often has a major impact on the emotional stability of the household, and that takes a hiding as well. So it's a horrible, horrible thing that exists in a place like South Africa, and people are unfortunately exposed to it because of lack of information. How do we get rid of that? So here we go again. Here's the family, and they build up a certain amount of wealth, and you've got the wealth there. Remember, left-hand side of this big red line over here is your personal wealth. But this family is a little bit smarter. They consulted with a company like ours, or professionals that understand trusts, or spoke to Gerald, who refers these things on. And they create a family trust, and they transfer certain assets into that family trust. They transfer furniture, they transfer the paid up vehicle, they transfer the Bitcoin wallet, so on and so forth. And now it, for all intents and purposes, no longer exists in their personal wealth, right? And they open up a property trust because they also got a property there that they don't want to put inside here because it's got a bond attached to it, which has a little bit of risk. So we don't want to mix it up with risk-free assets over here. And they put that property inside the property trust. So this is what we do with clients all the time, is that we take them from a place of having wealth here to a place of having absolutely no wealth in their personal capacities. Now, let's say that same event carries itself out, like I mentioned earlier, where they lose their job, retrenched, they're unable to pay the property. And look, the property's inside the trust, but the property has got a loan attached to it. So if the property trust does not pay that loan, the property will still be lost, right? But here's the thing, even though it's lost, they can't cross this line over here. So all the wealth that exists here, and of course, because you don't lose this wealth, so they can't cross this line, so you don't lose any of that wealth, because that stays as well, of course, the family stays as well. So essentially, you only lose a portion of your wealth if something like that happens. That's what we call compartmentalization. So everything the trusts own is separate from you, but they also compartmentalize between each other. So this trust's wealth does not affect this trust's wealth that was here, and vice versa. The wealthier you are, the more assets you have, or the more risk averse you are, you might have a substantial trust structure. We have some clients with 15, 20 trusts, but the average Joe usually has 2 or 3 trusts at most. And you essentially eliminate this domino effect of of litigation. Moving on to the next one. Just to sum that all up, own nothing, control everything. What does that mean? Is that the ideal structure is one where you have nothing over here, absolutely nothing. And your entire wealth is owned by a trust structure, 1, 2, 3, 4, 5 different trusts. And the beauty of that is very simple, is that because the trusts own all the wealth and you own nothing, you are not exposed to the issues of death and litigation, which I explained before this, right? But of course, who wants to have trusts own all of them, you own nothing, because that sounds a bit weird. But this is all fine, because at the end of the day, because you are a trustee of these trusts, you still enjoy the control of everything the trust owns. Remember, the trustees are like directors of a company. They control and manage the trust affairs. So you still enjoy this GTI, you can still get in it, and you can still control who's allowed to ride it and so on by virtue of being a trustee of the trust. And then the second thing is, because you're a beneficiary of that trust, you enjoy all the benefits of everything the trust owns, right? So even though the furniture is inside here, because you're a beneficiary of that trust, you get to sit on it whenever you feel like it and enjoy the nice leather couches or whatever the case may be. And for example, the property here, even though you don't own it, it's your home, it's where you live in, even though the trust owns it, you still enjoy the benefit of living in it because you're a beneficiary. So at the end of the day, you own nothing, but you control everything and you benefit from everything. So there's a very simple thing, if you do more investigations into the world of very wealthy people, is that most of the wealth they do not own in their personal capacities. It is all owned via structures, usually trusts. And I can name them off in South Africa. It's all the same. All the wealthy people, majority of them, their wealth is actually in trusts. Onto the more exciting part. So that's just the fundamentals. The reason why I wanted to show you the fundamentals is because the primary purpose of trust is to protect your wealth from the issues upon death and the issues of litigation. Those are the primary objectives. As a secondary objective and a secondary advantage, there's also some tax benefit, not some, there's substantial tax benefits to having your wealth owned by a trust. Best way to explain it is by virtue of a comparative here. So just follow me here. You've got three types of entities in South Africa. You've got the individual, you've got the company, or closed corporation falls into companies, and then you've got this thing called a trust. Sorry, I just need to move this across somewhere else here. Okay, so let's say, for example, you have a certain amount of taxable income. So this could be from anything. I'll use Bitcoin as a perfect example, or MTI. You generate a certain amount of taxable income from it, and let's say you generated 500,000 Rand taxable income for the year, right? The tax rate on that 500, let's say that was the only thing you earned for the year. If that 500,000 Rand was earned in your personal capacity, you would pay tax on marginal rate 0 to 45%. In this case, you'll see now it equates to an effective rate. ER stands for effective rate of 22%. For a company, you're going to pay at a flat rate of 28%. And then for a trust, which has got the worst tax rate in South Africa, if you don't know anything further than that, is 45%. So what does that equate to? On that 500,000 Rand earned, the individual will pay 110,000 Rand tax for the year, which equates to that 22% effective rate there. Company would pay 140,000 Rand on that 28%, and a trust, for all intents and purposes, would pay 225,000 Rand. So you can see first, second, and third place here, very simple, right? 110, best position, 140, second best, 225. Now, with trust, we have this wonderful tax law that allows us to distribute taxable income out of a trust to the beneficiaries before actually paying tax inside the trust. It's contained under Section 25B of the Income Tax Act. And basically what it says is that if we, when I say we, the trustees of the trust, opt or decide by resolution to distribute this 500,000 Rand taxable income to the beneficiaries of that trust before paying the 45%, then the beneficiaries have to include that amount in their tax returns as if it all happened in their personal tax returns, right? So to give it a scenario here, the trustees resolved to distribute the 500,000, but the beauty of it is that there's multiple beneficiaries, so you're allowed to distribute proportionately as you please to the different beneficiaries. So I've just given an example here. Of that 500,000 Rand, you distribute 200,000 Rand to the husband, 200,000 Rand to the wife, because it's equality and it's important, and then 100,000 Rand to the child. And you can have 2 children, 3 children, whatever. And that equates, of course, to the 500,000 Rand over there, right? That's what's in blue. We distribute it to the beneficiaries. You see the tax over there now disappears because we distributed that 500,000 Rand pre-tax to the beneficiaries. And so now the tax law says that the trust then does not pay tax on it, and the tax disappears over here. Now, the tax law further says that the husband or the wife or the child now have to include these incomes in their personal capacities, and it must be taxed in their hands as if it all originated in their hands. So individuals pay a marginal rate, as you can see here, at 0 to 45%. So each one is 0 to 45%. But at these amounts, what happens is the tax rate for 200,000 Rand, the effective rate over here, is 11%. Effective rate for the wife is 11%, effective 3%. And resultant is those amounts there. So this is the tax payable on that amount by the husband. That's how much tax payable for the wife, obviously the same because it's the same amount. And then for the child, it's 3,000 Rand. That comes to a total tax of 45,000 Rand, which, as you can see, is now substantially less than the best case scenario on the previous example, which was that one over there. I mean, that's literally like a 60% saving or something in that scenario. So we get the best outcome from a tax perspective here. These numbers just, it's so varied and so interesting because it is done according to the family unit. So you can imagine, like, if you have many children, the ability to distribute like this becomes extremely tax efficient. So if there's any reason to have lots of kids, you know, this would be it. At least there's major tax advantage to you or the family unit by having lots of kids. And
Michael, sorry, Michael,
yes.
that's bad advice, giving people to have more kids.
You had to climb in there. Oh, thanks, Gerald. Look, well, let's leave it to the audience to decide whether that should be form part of family planning right there. Yeah. Okay, so yeah, so you come out with the best result there. And that's the lot, Gerald. Nice and short, and I hope I kept everybody interested, even though I don't get proper physical feedback from the audience.
Yeah, thank you very much, Michael, for that. But guys, there is much more. Remember what we said, the introduction for Michael Dryden is the basics. We're just going to add more things to this. I actually sat down with Michael. He showed me things that excited me so much that I introduced him to Usher and his legal team, because I think there is much more to this than just showing us what we've got here. And I know we've got a big solution for the top earners. And we've got if I can call it, a get together that we want to organize for the people that are earning 100, 200, 300,000 a month in MTI. To obviously get much more benefit than what Michael has just shown us here. That we can't unfortunately record and make publicly available. That will be in private sessions because that is Michael's intellectual property, unfortunately. So Michael, thank you also very much for that. I saw it now twice. I still can't believe what you can get right, but yeah. I definitely will have a few things lined up in the near future. Also, we have on this call tonight Gideon. Gideon is also a tax practitioner. He is also a trust attorney, and he actually writes trusts. Okay, so Michael, you are in the limelight tonight, so just be aware. So guys, we're going to open up for some questions at the moment. Please keep it light. I know that as you have known, I've discussed some of the information with some of the members. Please don't share the intellectual property on this call as we record this. So please, I'm going to ask Graham. Graham, can you unmute yourself? Graham? No? Okay. Peter? Peter Dupree, can you unmute yourself?
Hi, Gerald.
How's it, Peter?
Yeah. Oh, thanks again for the session tonight. How's Michael? Thanks for sharing that information. I think there's a lot of things there, a lot of things in there that people don't know. You kind of make me scared to die.
No, man. I'm supposed to cast hope.
So yeah, like Gerald says, I mean, we're going to go in deeper, but you kind of alluded to this is the way it works in South Africa. Is it like the worst in South Africa when it comes to this stuff, or is it a general thing across all countries?
Oh, it's a general thing across all countries. Sorry. So the thing is that look, South Africa's tax law is extremely advanced. We're one of the most tax advanced jurisdictions in the world, actually. So yeah, but in general, in the developed countries, you know, UK, America, and so on, it's generally all very similar. Yeah.
All similar. Okay, and then just another question. I'm not too familiar with the trust and all that stuff, but I did hear from someone there was a recent change in the law that kind of negatively affected trusts. I'm not sure if you're aware of
Yes,
anything
of course. Yes, of course. So that was what we call Section 7C. It kept a good couple of accountants out of sleep for many months. Basically what it's about, it's a pity I don't have a slide on it right now because it's always easier with a slide, obviously. But what it's got to do with is loaning money to a trust. So what a lot of people would do is, in order to move their wealth into a trust, they would, if it's cash, they would just loan it to the trust interest free, or if it's property, whatever, they would sell it on loan account. So, and SARS, or the tax authorities, obviously didn't like this. So what they basically enforce is to say that if there's a loan account between, you know, a beneficiary or trustee with the trust, a credit loan account where the trust actually owes that person money, we essentially have to charge interest on the loan account, otherwise it'll be seen as a deemed donation. So it just messes up the structuring slightly. The unfortunate, so just to recap again, just before I continue that, is that it's all to do with forcing us essentially to charge interest on loan accounts between the trust and a connected party. It was frustrating. The only thing that was frustrating about it was that it was done in retrospect. So what happened was we would have clients that had a trust for 10 years and built up a loan account of 10 bars. And then they come along and they change the law, and now it applies to the entire 10 bars, which came along over 10 years. As opposed to saying something like, okay, fine, look, the law is now effective from now, so any loan accounts going forward is subject to it. So that had people running around like crazy trying to find workarounds and so on. We've got a workaround, so there's no issue on our side. Very few accountants have the workaround because it's, again, specialist knowledge. So it's not, it was problematic for us at the beginning, but not anymore.
Okay, cool. Thanks for that, Michael.
No
yeah, I've got a few more questions, but I think I'm going to stop there because we're going to go into this deeper in future. So,
okay, I look forward to a consult with you. Eh?
Yeah, that sounds good.
Awesome.
Thanks, Michael.
Cheers.
Thanks, Peter. Guys, anybody that wants to have a private consultation, we will definitely arrange it in a group session and then into your private sessions to also share with you guys the intellectual property. For that, just WhatsApp me your personal information, it's your name, your username, your cell phone number, and the email, and then we can set that up for you as well. Marinus, jy is aan die woord. Marinus, ons kan jou nie hoor nie. Okay. Yuri.
Yeah, thank you, Gerald. I just want a great presentation. I love the information, Michael. I just want to quickly ask. My brothers and I have been speaking with each other about doing something like this. Would you recommend each brother creating their own trusts, or is there benefit in doing it as a group?
It really depends on the objective. Eh? So most times a family unit wants to have their own wealth, you know, in their own trust. So under normal circumstances, probably 8 times out of 10 in consults that I do, it would be separate trusts. which then the trust can go into partnership, or the trust can own shares in a company that then is essentially the entity that's used. But there are situations where we can create a trust where both you and your brother are obviously trustees and beneficiaries. Sometimes you do it for consortiums, property consortiums, which is probably what you're referring to, might be referring to. But it's the beauty of trust is that it is bespoke. It is 100% customizable. So in the consultation, we go through, what your objectives are, what your fears are. Some people are super risk averse. Some people are just they're just attracted to risk, and these things all affect how complex or how simple a trust structure can be. And I just want to add to that is that when we talk about trust, it doesn't mean that companies don't have its place. What we ultimately want is that wherever you're operating from, wherever you opt to operate from, that it ends with a trust. So if the best entity to operate out of, let's say for you and your brother, is maybe a company rather, a PTY Limited, we would then just want the shareholding in that company to be owned by your respective share trust, is what we call it, or business trust, and you would have each of your own one. So to answer your question very frankly, it's entirely based on what your objectives are, and this is what those consults are so important for.
Thank you, appreciate it.
Cool.
You guys are based in Cape Town, right? I'm up in
Yes.
Pretoria though.
Okay, so we can obviously do it on Zoom, but we do come out to Johannesburg side once or twice, once a month,
Alright.
every second month, so we can definitely coordinate it.
Awesome, thanks.
Yeah, cool.
Thank you for that. Marinus, can I ask you just to log out and log in again? Because it seems like your mic is not working there. I tried now to unmute you as well, so that we can just get your questions answered. Ian.
Yes, thanks, Gerald. Yeah, Michael, how you doing? Thanks very much
Good.
for an awesome presentation.
Thanks, Ian. Thank you.
Great. It's just a question for you. How would one structure if one was looking at buying property internationally, and then living part of the year in South Africa and then part of the year outside of the country? How would one structure that in terms of trust in and out of South Africa?
Sorry, Ian, you're not that clear. Are you saying in terms of purchasing property outside of South Africa?
Correct, yes.
That's correct. Yeah.
Okay, so sorry, Ian.
Yeah, so for example, if I wanted to go buy a house in Portugal, so Portugal's a very crypto-friendly country, there's zero tax on crypto gains. So if I wanted to buy a property there and structure it in a trust for my family in South Africa, is that possible? Is that something you could assist with?
So we are a little bit apprehensive to have international assets owned by a local South African trust. It's a simple thing, like South Africa's political landscape is always a point of contention. So where you acquire assets outside of South Africa, you essentially protecting yourself from the dramas that is, that constantly unfolds in South Africa. But then if you go and purchase that property in Portugal in a South African trust, then you're essentially just exposing it again into South Africa's political landscape. So much better suited for those kind of things, and this is 100% recommendation from our side, is that if you're acquiring wealth that is not in South Africa, you have it owned by a structure that is not in South Africa.
Okay. Awesome. But I'll be seeing you soon in one of the private sessions. Thanks, Michael.
Cool. So, sorry, what did you say, Ian?
He said he will do a private session with you. I've already got his name on.
Okay, awesome. Yeah, please do.
Thank you. Luwayne.
Thank you.
Ah, Gerald, come on, don't. Yeah.
Where's Marinus now? Sorry, Marinus.
I'm back. When you can.
Michael, just hold on. Michael, just hold on. I normally do a mastermind session for his team, and he's normally about 200 people on the call. So I had to sneak him into our call tonight. So some of his
right.
is also awesome. On the call. So, Marinus, the floor is yours.
Thank you, everybody. Michael, thank you. It's very insightful. I really want to ask most probably a very uninformed question. But let's say, for instance, my business do some shady deals, whatever, money laundering or whatever.
Sure.
And are you protected from the trust perspective. So won't they, if you in your personal capacity, you're a director on a trust or a trustee, won't they come for you, even though, you know what I'm saying, and come for
Yes,
the
yes.
trust?
That's a brilliant question, Marinus. It's something that I often do touch on in presentations, is that these trusts, we are very careful, as FinServ group of companies, we are very careful with who we share this information with, because the unfortunate reality of trusts and removing your wealth from your personal capacity is that these things protect bad people as well, really bad people. People, like you say, laundering, trafficking, and so on. And if they park their wealth in a trust, it's very, very difficult to penetrate that trust and take the wealth out of there. So it's a sad reality that the trust can be used for good and for bad, but I suppose that's virtually anything on this planet. So as a selling point, I often say if it can protect those really bad guys and their wealth, you can only imagine how it protects a normal person who is going through something that was completely out of his or her control, if you understand what I'm saying.
Thank you.
So to answer just frankly, to penetrate a trust and remove wealth out of it, it's a very, very difficult task.
Thank you, Gerald. And I'll love to make use of the opportunity to meet with you on a personal basis, but we'll arrange this for later.
Assuming, of course, that you're not laundering money and stuff, right?
No.
Michael, remember,
I understand.
Michael, remember, he's one of the brothers of Ashabel. So.
Okay. I met him last week. Yeah.
Wonderful. Yeah. Thank you, Michael. Awesome.
Thanks,
you.
Marinus. Natalie. You can unmute yourself, Natalie.
Yes, good evening. How are you?
I'm very well. You?
Good, thank you. I'd just like to know, when we're introducing the concept of MTI to a client, should we ask if they have a trust? Should they open the MTI account in a trust account name, or would they actually use their personal details and do a will stating that it must go to the trust? How would that be structured from the beginning?
Maybe I can just take that quickly. Because of the KYC and the FICA that is coming up in MTI, we would like to get those the trust structures in place as soon as possible, especially if you make a decision to build this as a business. Yes, so one of the things that I started doing and asking people in questions, do you have any trusts? Are you going to do this in your personal capacity? Just remember, there is benefits and there is also benefits in the trust structures. If you have got questions about it, I cannot answer it because I'm not a tax consultant, but I can introduce you to Michael or some of the other guys that we do work with. So for me, that opens just another door as a conversation to help the client make better decisions. So, and that's what we are here for, not to make decisions for them, but give them the right entity so that they can make decisions.
Simply just guide them in the right direction. Because this is obviously something we're going to have to establish before we start jumping the gun and signing 500 people up. And in the meantime, they actually have great wealth. And then they're sitting with tax problems.
No, definitely, for sure. And that's why also there is people on the call tonight that I called in their personal capacity or in their, call it business capacity. They have got much more thinking than what we have. And that's why they are also here to help us make better decisions in the future. So yes, definitely. But for me personally, I say most of the
if somebody has signed up.
Yeah, but most of the people that start up with MTI starts with making a decision they want to put 10,000 Rand into MTI. So it's not a big wealth portion. It's not a decision to make a business out of this. And as they grow on in the timeline, the quicker the better. That's always just my advice. I mean, to set up a trust structures can cost you anything from 5,000 to 15,000, depends on where you do it and from which companies you do it. So for somebody putting in 10,000 Rand into MTI with a Bitcoin, and now they've got to open up a trust structures or two structures or two PTYs and a trust structure and try and keep it as simple as possible. Let's get them into MTI, and then later on when they start building wealth, get them to the right people.
Would we be able to change it from our personal capacity and transfer the accounts into the trust account? And would there be a cost of it?
Yeah, there is a bit of a capital gain. Michael can obviously help us with that also, and some of the other guys. Gideon is also on
No,
here
just from the
tonight.
MTR side, not from the financial side. I'm just talking 100% MTR.
Yeah, you can change it
Let's say I
anytime.
got something on
it's
my
a
name.
yeah, if it's a request done by the person that is the owner of that entity, it can be done.
Mm-hmm. Excellent. Thank you very much.
Thank
Good
you.
night.
Thank
Thanks,
you.
Natalie.
Luane, sorry.
Good evening, Gerald. My question is for Michael. I just make sure with regards to the trust, if obviously we've acquired wealth in our personal capacities at this point in time, the cost factor to now change, let's say, your house to convert it to the trust, what is the implication of that, or is that for new properties that you're looking at? What would the rationale will be with that?
Yes, yes. Look, great question again. So, what happens is, because of South Africa's tax laws, it is very difficult to transfer existing wealth into a trust from a cost perspective. So, it's unfortunate. There's a little bit of a misconception is that you've got to be wealthy in order to have any need for a trust. And the reality is that if you're really wealthy, really significantly wealthy, we can't actually help you that much, because to move the wealth across is going to cost a significant amount of money, and it's all to do with tax. So to take a property, if you're talking about cash, for example, moving cash across, no problem. But any appreciating asset, right? Assets that grow in value over time, those are problematic. And of course, properties falls right into that. So if you had bought the property for R1 million and you want to transfer it now into a trust because you want to protect it, it has to essentially be sold at its current market value to the trust. So if its current market value is 2 bars, R2 million, and you bought it for R1 million, then there is a capital gain of R1 million that needs to be accounted for. And look, if it's your home, you got an exemption up to R2 million in any case, so that scenario wouldn't actually trigger any taxes. But anything larger, or if it's an investment property, then there would be tax triggered. So if you want to just write this down quickly, there's 4 costs to moving a property to a trust. There's the capital gain. Then there's transfer duties that is payable by the trust. That's a tax on transfer of property. And that's on a marginal sliding scale as well. And then you've got the conveyancing attorneys who deal with the actual transfer at the deeds office. And then you get the bond attorneys, if there's a bond involved, who also have to obviously register the bond. So you've got 4 total costs. And depending obviously on the size of the property, that could be very little or it could be absolutely substantial. So these again, this is again in terms of where the consultation comes in. We can run these things off very fast. If you give me the details, I can give you basic numbers of how much it will actually cost to transfer.
Okay. Thank you, Michael. Thank you, Gerald.
Thank you.
Thank you, guys. Boyson.
Hi, Gerald. Desmond here.
Desmond, yes.
How's it?
Okay, you got a question?
Yes, Llewellyn actually asked my question, but I've got just something else on top of that. Michael, thank you very much for your time, obviously. And then just in terms of running a trust, what are the costs on an annual, monthly basis, or aren't there any real costs?
Yes, I actually forgot to include that slide. Sorry about that. So there's a registration cost to actually form the trust. Most people take the discounted rate, which is about 5,000 Rand to register the trust. If you don't take the discounted rate, which is to do with appointing us as accountants and things like that, if you don't take the discounted rate, then it's 7,000 Rand, this ex-VAT. So it's between 5,000 and 7,000 Rand to register it. And then to operate it on a monthly basis, you're going to have an accounting fee of about 400 Rand a month. If you have a company like ours as an independent trustee, which you don't have to have, you can appoint somebody else, a friend or whatever. But if you appoint us, for example, it's an extra 250 or 300 Rand a month, and then a bank account of $100. So you're talking about a monthly running cost of less than 1,000 Rand a month, which is less than your DSTV bill. So I cancel my DSTV bill so I could have trust to protect my wealth.
Thanks,
Got
Michael.
it? Cool.
Awesome. Thank you. Thank you. Thank you, guys. Guys, we're going to wrap this up. There is a few people that I would like to have a private call with Michael. One of them is our attorney, who is Gideon, who is also online tonight. So he wrote, I saw he wrote like 7 pages of notes that he wants to ask you. So we will definitely do a private call with that and some of the other members that have already sent their information to me. So Michael, thank you very much for your time. We mostly appreciate it and love at home. And guys, if there's anything else, please send us information on WhatsApp. We will do have this recording available so that the people can go through it, but please don't share it outside of the people that was online. That is for private information only. Thank you, guys. You must have an awesome evening. Michael, thank you very much again, and love at home. And we will definitely see you very, very soon.
Thank you, everyone.
Thank you.
Thanks, Gerald. Thanks, Michael.
Thank you.